Good evening and welcome to the John Sanchez Show here on News Talk 780 KOH. This is Jason Gaunt. I'm your humble host tonight, but fortunate enough to be joined by two of the best in the business. I've got Corey Edge of Edge Realty. How you doing, Corey?
I'm doing fantastic, sir. How are you?
I am doing wonderful. Always happy
Happy
to
New Year.
talk to you guys. Yeah, Happy New Year. Happy New Year. And Dwight, how the heck are you, my friend?
I'm doing great, Jason. Good to see you.
I appreciate it. It's nice to be invited into this group.
Yeah, as always.
Guys are looking great. You know.
Just a little older.
A little older.
A little older. We're all a little tired.
Wiser.
You know.
Supposed to be wiser.
Wiser. If old equals wise, I definitely feel a little bit wiser. We got a great topic tonight. I'm probably thinking, once we get a little bit of a market recap here, let's jump right in because we're hearing a lot of things out of the Trump administration as far as housing and notably institutional ownership of housing, right? Apollo, Blackstone, a lot of these folks have been buyers of both the single family, multifamily, et cetera. And I think it's shaken up things a little bit. That you had home builders down, home builders up, the big institutions down, the big institutions up. But I think we have two great guests on here who'll help educate us a bit on what's going on. But I'm going to quickly update you on markets overall. We did have a Dow. We've seen a bit of a back and forth over the last couple sessions. Interested to see about a month from now to see if this meant anything. But today the Dow was higher by 270 points or 0.55%. to 49,266, the S&P. It was flat, not dissimilar to yesterday, even though the S&P was a little bit lower. And the NASDAQ today was down 44 points or 44 basis points or down 100 points to 23,480. So you had a Dow up 0.5% and a NASDAQ down 0.5%. Gold up a little over 0.5%, 44.87. Oil up 4.3% today. So despite this massive new influx of oil, we've seen oil prices start to move higher. Bonds were fairly well contained, Dwight. About 2-3 basis points today on the day.
Yeah.
But surprised to see how calm they've been in the face of some of this geopolitical angst. And you mentioned something before the show started that we'll touch on later that I think is pretty cool as far as refinancing, et cetera. But why don't we jump right in, guys? We heard recently that Donald Trump had made many different comments. This is just one of them about institutional ownership of housing. That it was saying that people live in houses that institutions don't. And there's lots of funds out there, both private credit, private equity have arms where they own housing, single family housing. I know Blackstone back during the big GFC was buying the snot out of single family, multifamily homes while folks were being punted from them. So why don't we just start it off there? Corey, Dwight, jump in. What are your thoughts? What color do you guys have, from your seats as to what this means and what it could mean going forward?
I think, we've talked about it a little bit before. I know the state of Nevada has talked about doing some legislation to keep some of these big investors out of the housing market. I don't know personally how much of an impact it will have. Well, I guess let's do two things. Here in Nevada, specifically in Reno, what effect will it have? Probably zero, right? There's just not enough institutionally owned homes here. Some of the cities, Atlanta, Phoenix, different parts of the country, maybe it'll have a little bit of effect, but I think, and correct me if I'm wrong, the overall ownership of these institutions in the overall market is 2 or 3%, maybe.
Yeah, it's not as big as you would think. Yeah, correct.
It's not massive, but I do think a couple of things that when the politicians here locally talk about it, it's always, to me, has a political spin. Like, we're going to go get these bad guys and get them out of the market, even though it's not going to change our market. I give President Trump a lot more credit than that. He's not just using the bad guy thing. There's got to be something else going on in the background, because he's got connections into that world, and he's not going to do stuff that outright hurts Wall Street unless there's some kind of give and take there. So it'll be interesting to see how this flushes out. I do, it feels like a lot of these companies were going to be getting out of this business slowly anyway.
Mm-hmm.
And I also want to give them, Dwight might disagree with me a little bit. I want to give them the kudos that they deserve from, if you remember the depths of the Great Recession, these people, maybe they caused it, who knows? They were the villains that came in and started buying houses, but without that backstop, who knows where that market would have gone. So they did a decent thing in the market at the time we needed them, and now maybe it's time for them to move on into other things.
So The thing that always pops into my head is these aren't nefarious, angry, free market capitalists out there waiting to prey on the demise of, the little guy. By and large, these are credit funds or funds of some kind that are held inside of, probably not Nevada because they're running a slightly different allocation, but inside of many state and local pension funds and individual folks who have holdings in these credit funds. They're just investments that a lot of these places have bought, that some of these who are crying foul may actually have exposure to some of these things. What are your thoughts there?
Yeah, I agree on that. And I also think we will see how this all flushes out. But you need to be careful what you wish for, because even though it's only, let's call it 5% of the market, if they decide tomorrow this isn't worth the political angst and we don't want to upset the White House, let's put these things out to the market, that will be good for buyers. That will not be good for sellers. So the people that may argue that they need them out of the market, if you are a property owner, the tight supply is what is keeping your price where it is and levitating where it is. And so you quasi need that supply to stay tight in order to keep the pricing where it is. So you're right. It's these things, if they come through, usually create winners and losers that we haven't thought of yet, because it goes multiples down the line to see how it impacts people.
Dwight, your thoughts?
I agree with Corey. I think they're chasing the wrong chicken here. You're talking 5%. I mean, and Corey's right. In those areas where the investors came in, they did hold those markets up. I mean, we didn't get to see it so much in Reno, but in Vegas and in Phoenix, and Corey's already named a few of them. They came in and did what needed to be done. I think that, I saw one of his cabinet members talking about this very thing, and they're going, they can go find rate of return somewhere else. Well, I mean, we're making them out as villains, and I agree there's going to be unintended consequences somewhere. Somebody's going to lose, and I'm not sure who it is. And it's not going to be the Blackstone. I mean, it's not going to be these big. So, I mean, it's probably going to be the average day American's going to. So I think they just kind of let that go. Maybe just don't get in a situation where you allow that to be a big appetite for these companies, and we'll get onto it, but I like the quantitative easing part for the mortgages. I think that will help. But when you look at it, admitted on, or I guess it was Aaron on Tuesday, the market has slowed down. I mean, so it has already had, or is having, its natural course, the cycle right now. And Corey, you've said it many times. So sure. Why come in and not throw a wrench in it? I don't get it. They're smarter than that, I guess. I hope.
And it's outside of the Blackstones and Apollos. It's also the Invitation Homes and AMH, where there's these essential rental communities, right? Where they're coming in and purchasing up land, building homes, creating what feels like a HOA type environment, but it's more of a massive rental community.
Yeah, but those municipalities, Jason, are allowing that. Yeah. They're approving that already out of the gate. So if you don't want it, if you want to create everything's, I always believe it's all about trade-offs, right? What can you give me, Mr. Builder? If you want, what can we, how do we even this out? So I think though, I'm a little more on the builder side. If they're willing to take that big old huge risk and build all these houses and rent them, so be it. I mean, I don't know.
Yep. And they're stocks, right? A lot of these are publicly traded equities that, like we said, it's a function of incentive structure. It's a company that's created to go do this. It's not like it's a hedge fund levered up going out and trying to blow up a leveraged buyout of some community where they come in and rip all the copper out of it and leave it for dead, right? So I agree with you. It's trying to and this is not uncommon with politics in general. It could be Democrats, it could be Republicans. It's identify them, and then people create angst. They're frustrated, which you guys have talked about so well for many years. It feels like at this point, people are frustrated with the housing dynamics in general, the cost to buy, the cost of ownership, and it probably could be something more. Government involvement, but not necessarily in this, where you've sort of socialized the risk. If you don't want to own the stock, sell the stock. If it's a bad investment, people will sell it and the market will tell you. But in this case, it may be someone, and after the break, we'll touch on, I think this is symptomatic of more a larger concern that I and others are having, is this administration, which others do as well, but to some extent, they're sort of putting thumbs on different scales, saying you're going to be a winner and you're going to be a loser. Other administrations have had that for different reasons. May it was green reasons or handshake reasons, but almost this sometimes feels like it's you ticked me off or hurt my feelings at some point, and now I'm coming after you now that I have the ability to do so. And we're seeing more and more of that. And I think that companies are going to start to get a little either almost unionized to some extent, I've heard rumors of, to be able to push back in unison versus any one person speaks up and they get whacked over the head. We'll come back after the break, but why don't we first check in with Kristen Snow in the Right Now Traffic Center. How you doing, Kristen? Welcome back to the John Sanchez Show here on News Talk 780 KOH. This is Jason Gaunt, joined by Corey Edge and Dwight Millard. And the two of us are talking, three of us? We're talking about Trump and some of the announcements around institutional ownership of homes and some of the pros and cons and concerns that at least we identify around that announcement that is filled with a sea of other announcements. But first, let's check. We got the Dow today was up 270 points, 0.55% to 49,266. S&P was flat in the day. We'll call it 1 basis point higher just because green feels better than red. 21, and the NASDAQ down 0.44% to 23,480. Gold higher by $27 to 44.88, and oil higher here about 1% higher in the new session to 58.37. So into the break, we were discussing some of the comments around institutional ownership of homes. We talked about not only the private equity, private credit firms, Apollo, Blackstone, but the invitation homes and the like. And in between the break, Corey brought up a good point that there's some builders that are doing even a bit more of creating communities and sort of setting the table for investors. Why don't you talk a little bit more about that, Corey? It's pretty interesting.
Yeah, and this is I don't want to say it's happening here right now because I know it has happened, so I don't know what is actually being built today to this specs. But if it's happening here, it's happening everywhere. And they're building full subdivisions, call it hundreds, maybe up to thousands of homes that are specifically earmarked to be sold to one of these type of funds for rental purposes. And so when you sit back, I guess probably at first glance, if I'm a Democrat politician, I think, oh, that's 500 people who got screwed out of a house. Well, as we were talking about on break, I guarantee if you offered each one of the people living in these houses to buy it, maybe 10 or 15%, maybe up to 20 could actually buy it. So to us, you're providing housing in very nice neighborhoods, brand new homes, HOAs, all the stuff. You could argue that maybe the rents are a little bit steeper than the house down the street, but the house down the street's 30 years old and has some inherent issues. So these things aren't all bad, and that's why, again, as we were talking about off break, I think Trump is tied in and hopefully, and I think smart enough that he's not going to take a Wall Street faction unless they really upset him and make them losers. There's something on the back end to benefit. He's a handshake behind the scenes guy, right? Like there's a benefit to either him or somebody he knows in all of this. And then midterm elections, we talked about, it is a good headline going into election season.
Yeah, Jason, we talk about it quite a bit, and I've actually even said I see the Feds lowering 5 straight times. My rationale is that Trump's got to do all of this stuff we're talking about. Otherwise, he runs the risk of losing the midterm, and then his entire agenda's gone. So he's got to turn this ship around. It was a sinking large ship. He bailed the water. He's trying to turn it, and he's got to turn it fast. People are getting restless. You see it maybe in the gas prices a little bit. You see it at the grocery store, but people want more, and he's got to get more. I mean, I hate to say it, but people we're fast food mentality. I got to have it now, and if I don't get it, I'm going to vote you out. So I think everything's on the table. Multiple things are on the table.
You'd mentioned refinancing.
Yeah.
That you thought that, sometime over this cycle, you could see what levels of refinancing, at least per your expectation.
So what was interesting on this conference call, this was a 2026 to 2028 projection. And this is all your biggies, Fannie, Freddie, but the volume has gone up now almost to 2.3 trillion in business. But we did 32% last year, 2025 refinances. They're anticipating somewhere around 37%. So you can imagine that all these numbers of people that had less than 4% was massive. But over now the last 3 or 4 or 5 years, that has shifted. So now that average, I think they said that average is like 30% now or 28. It's under 4%. So you're going to see, I think, the gist that I got, you're going to see quite a bit of activity. Just make sure you're doing your work and you're working hard, and But it was very bullish to be.
Yeah.
It was. I mean, even from new constructions, resale, it was very, very. And I told you once I get these, I'll share them with you guys. But yeah, it was amazing because I didn't think we did that many in refinances last year, over 30%.
And Gaunt, I'm curious, and I don't know if they give you the nitty gritty detail, but is there a way to see what percentage of those are cash out refinances? Are people just grabbing the stored up equity, or are they just doing rate and term?
So I don't know if they break it down, but that was the number one refinance was cash out. That was the number one reason for the refinance. I don't know if they have it broken down. I mean, obviously, Corey, we got life continues, you got college, you got divorces, you got all that stuff. But I think that the cash out refinance was probably one of the biggest, that was the biggest leader of the refinance.
Cash out by NVIDIA. You think that trade? Just, rip all the equity out of your house.
It worked, and then
right.
You can just pay it off as the stock goes up, and then you get
perfect
house.
Yeah.
We're not recommending that for all.
I was just going to say, you're not pushing for that, right?
Yeah.
You can see us on YouTube. We were all laughing, but yeah, I'm even surprised as you said that refinance would be that high. I mean, my brain, I feel like anyone out there with a mortgage has a 4 handle on it or lower. Right. I often talk to clients, and another reason why I think that Trump administration in general wants to get rates down is because of back in 2021, anyone like we've talked about that was in the market was refinancing, had a 2 handle or at the very most low 4. Well, companies were doing that too, right? But they don't borrow for 15 to 30 years. They borrow for 5 to 7. So there's north of $1 trillion of corporate debt that needs to be termed out in 26, 27 as well. And I think that's a big overhang on the market too, where they're going from what was 4, 5, 6%, 5 to 7 year paper to now 7, 8, 9, 10% probably. And the only real buyer for that stuff could be credit funds, right? So that's the part that I also think is a potential overhang for the markets into the next couple of years, is certainly the consumer side with jobs and AI, but also this big amount of corporate debt that is out there that needs to be refinanced.
Well, what was interesting, Jason, is that these numbers were based on a interest rate around a 6 1/8. So imagine if we get down to a 5.5, 5 3/8, 5 1/4. Imagine if we get 75 basis points knocked off where we're at or where they think we're going to be. Those numbers get skewed to the positive. I mean, you'll see even more. So it'll be interesting. It's going to be, and I think you're going to see it sooner rather than later. Trump can't wait. This market can't wait. It's got to get it going now. So it'll be interesting to see at least the first quarter and early second quarter, how aggressive this will play out.
Especially as it comes right into the midterms. Why don't we check in with Jack Sabin now, who has news, traffic, and weather. How are you, Jack? Welcome back to the John Sanchez Show here on News Talk 780 KOH. This is Jason Gaunt, joined by Corey Edge and Dwight Millard. I'd say the Dow was higher by 55 basis points, 0.55% to 49.26. The S&P was 1 point higher, if I round up, to 69.21. The NASDAQ, it was lower by 104 points, 0.44% to 23,480. Gold here in the new session higher by $27 to 44.88, and oil up 4+% today, up another percent here in the new session to 58.37. Before we went into the break, we were talking about some of the announcement around President Trump and institutional ownership of housing. We're talking about interest rates. Thought that we could see a decent amount of downside in rates, just given the thought of much refinance we've seen so far, but also pressure from President Trump in and through the midterm elections. Corey had pointed out, kind of coming into the show, there was a quick announcement around up to $200 billion from the FHFA to purchase mortgage bonds, and I was wondering what your guys' thoughts are about that, and what that could potentially do to the rates market on the mortgage side if the Fed decided and or Fannie Freddie decided that they were going to become a buyer again.
If you own Pulte homes, you're all for it, right? Let me sell more homes, right? But, it reminds me, of kind of what we did coming out of the 08, 9, 10 meltdown, where we were buying the treasure. I mean, I guess it was the Feds buying the mortgage back. Here they're taking money, like Corey said, out of Fannie Freddie and going to go buy it. I think it would be huge. I think that this is I don't think you'll see with that kind of money. Corey he's right. It's not a lot of money over a short period of time. It's going to be more money. It will be that may bring rates even closer to the 5.25 range on a 30-year fix, which then for a point gets you into the 4s. I think you'd see a lot of activity out.
Because I think they were running off the MBS balance sheet was $20 billion a month, right? So
Okay.
it would be essentially 10 months of a reverse, for lack of a better term, with a different Fed. I'm sure this would be put into place, maybe not necessarily now, but as you were saying earlier, Dwight, in and through the election would be a fair amount of firepower to get voters happy for sure.
I think so. And it'll allow the first-time homebuyer. They're predicting the first-time homebuyer market to actually start really, really being an impact in this year. And it was crazy. I think last year was still in the 30s, first-time homebuyers. I mean, it's kind of a pretty balanced market right now. When you look at it, it didn't feel like it's just the volume was way off. I mean, we just barely surpassed 2 trillion. Put that in perspective. We did 4.4 trillion in 21, right? I mean, that's a lot of dough out there. Yeah. So I think, you're going to see a lot of activity. I think that there's going to be a lot of pressure to our point is, to get these rates down.
Well, and the question is too, it should help with affordability, but you're probably not going to see prices come down in that respect. I guess, you add more demand into a narrow market, then the prices should go up. But if the cost to do the business goes down, it should be good.
Yeah, but Corey, you even said though that if rates actually went down where people could move around, you might see an inventory surplus of those that needed. I mean, remember you said
Correct.
it could have an opposite, and if it did, then you'd have to naturally drop your price just to compete with the guy that's. So yeah, you're right. It's a unique scenario we're dealing with.
Yeah, does it spawn more supply, Corey?
What's that?
Does it spawn more supply?
I think yes. I mean, I've always thought, and I could be wrong, that technically the sellers are kind of sitting on the sidelines. All they've done is watch their Zillow value go up and up and up and up and up. We've been plateaued for a couple years now. I'm looking at the chart right here. But I get the sense, I think, as normal Americans do, the minute they feel or see that starting to go down, it'll kind of be, I don't want to say a rush for the doors, but they want to get out because they've already spent that money. And as Dwight mentioned, a lot of them have already tapped that money. They've got it in their bank account, and so now they need that value to stay up there. But you could see something. It's weird how these things work out. The common theory is if we bring rates down, prices will go up, and we'll have all this inventory. Well, look at what happened with prices and interest rates over the last 3 years. Rates went through the roof and prices went through the roof. You can't really, to me, gauge out, if this happens, that'll happen, because this whole thing's kind of upside down. So you could see rates go down. People that have been trapped in their houses say, man, we can finally go get the house we want. We've been here for 10 years. I hate this place. Now we got rates down. Let's go buy another house. We'll put ours on the market. And if that starts adding inventory to the market to where it gets a little saturated and people have to compete to bring their price down, it could be a domino effect where I don't want to say they all, but people could say, wait a minute, my house has been stagnant for 2 years, but now it's actually down 10%. Mm-hmm. I'm not going to let that happen.
And anyone who's been sitting around waiting to be a buyer either had their money in the S&P 500 or they had it in a high yield savings account, right? So they've seen S&P value go up. They've, on the flip side, seen their savings account interest go down. So they'd be more hungry, for lack of a better term, now at the opportunity. If, okay, now rates have come down, I feel comfortable jumping out of here where I wasn't making as much as I was before to take that risk now, to be that first-time home buyer, et cetera.
Yeah, but Jason, that goes along with that, the great wealth transfer, or whatever you guys, how you guys describe it. I mean, if you give a holiday to capital gains tax, which I still think is one of the smarter plays. If you would,
Absolutely.
like to Corey's been talking about, if you take it from whatever it is, Corey, 20% down to even 10, you know, or 0, or whatever you do to get people, that would be helpful too. I mean, you know, these are all, I think, fantastic ideas that we just need them implemented.
Yeah, and I think it's just you got to be a little careful, and I think they're smart enough that if you do the things to unfreeze what they call the golden handcuffs, which maybe they're not even real anymore because people have been refinancing, but if they do whatever they have to unfreeze this inventory to get it on the market, a mass amount of inventory should bring the prices down, which is what those people don't want. The people that are coming to the market don't want the prices down. They need to sell at today's prices. But as you mentioned, Dwight, if they did either the capital gains reduction or say no capital gains on primary residence if you've been there right now, what is it, 3 out of the past 4 or 5 years, or maybe do 5 years straight or 7 years or whatever it's going to be. But you got to be careful because the consequence of that may be everybody wants to sell. Now you've got more buyers, you know, or more houses than people that are going to do with them. So.
Right, and then they'll want to move into these like rental owned by institutional houses, right? Because you'll sell your house and then go rent and somewhere. Yeah. But no, I mean that is true because much like the you know, had someone today, hey, our Social Security's free, right? I'm like, no, it's not. They gave you $6,000 credit or $12,000 credit for 3 years, right? So there's all these like little 3-year things that I'm concerned become more of the norm of, hey, you know, like a used car salesman, you know, get it before year end, that it could create a big seller's market, right? Or rather, you know, buyer's market in the sense that all the sellers come out who are like, I want to take advantage of this capital gains holiday, et cetera.
But, you know, the other thing they could actually do too is, you know, they put, remember they increased the loan level price adjusters on second homes. Remember they made them much more unattractive.
It's ridiculous.
Very ridiculous. They ought to back that down a little bit, right? Now that's a Fannie Freddie add-on. FHA doesn't allow you, to do that, but that's so maybe they can. There's just lots of ways to kind of do this. And to Corey's point, I don't think you do it all. You kind of take the ones you think might. I don't know even how much you have to do because it's almost already showing signs of slowing down and all of that, but. Again, I just don't think it's fast enough for the general population before a November election.
Yeah, I was always confused by the second home add-on as far as rates are concerned. So you're telling me I own my primary home outright. I'm going to buy a second home and I have to pay a higher interest rate on that loan because it's a second home. Like you would think those are the buyers that they would want. I know that would theoretically be the first one you walk away from, but like it just screams of sort of confusing to me that anyone can afford to buy a second home potentially has more of a backstop than someone who just has their primary home.
No, I mean, and the rate and all the qualifying mechanisms basically mirrored that of your primary residence. But then somewhere along the line, they got this infinite wisdom. I think it was, 19 or 20, Corey, right? I think what they want to do is put the brakes on second homes. They were afraid that all these people were buying these second homes with 10% down, you know, great rates. Something happens, they're going to walk away from them. So I think it was a strategic move to slow it down. But now you can look at it again. Everything should be looked at again.
Agreed. Yes. No, I completely agree. Especially things done in tumultuous times that become too long. And that was part of, you know, I'd say the complaint that even Trump brought up back in the day of, you know, there's too many things out there that are maybe were put into place, you know, that don't even make sense anymore. And I think that's a relook of a lot of these laws, tax laws, et cetera, that need to be blown up and revisited, I think makes a ton of sense. Much more to come in the show, but why don't we check in with Kristen Snow in the Right Now Traffic Center. Welcome back to the John Sanchez Show here on News Talk 780 KOH. This is Jason Gaunt, joined by Corey Edge and Dwight Millard. Been covering as much as we possibly can of the recent announcement for, whether it's an announcement, I think he's going to discuss it at Davos around affordability and such, of institutional ownership of single-family homes. It's both on the private credit side, where there's credit funds that go out and purchase these assets, or private equity firms that went out and did the like. And there's publicly traded companies like Invitation Homes that their whole business is creating these communities that are rental communities that are not homes or, you know, rent to own type things. It's all rentals. And by and large, the pushback is that type of an effect is potentially driving prices higher or keeping a floor under rental prices that otherwise may be lower. Talked about things like potential $200 billion of FHFA money being redeployed to buy mortgage bonds again. I mean, that is technically what their business is versus the Fed, who was buying MBS back during the financial crisis. But another thing you sent over, Corey, is 50-year mortgages. And I'd love kind of Dwight's view on, that type of an instrument too, and how it may or may not affect his business, capital gains tax holidays. Just any other things that you've heard coming down your path that may be tossed out there, especially as we get closer and closer to the election in the interest rate and or home area?
No, I think that we've pretty much covered the gamut of what I think is of real discussion. I mean, there's other things out there, more non-QM market and all that. That's a disaster. I mean, I think what we're talking about is legitimate, real things that can happen. I think the 50-year, we talked about that. It's worthless because by the time you take it out another 10 years, that rate's going to be higher than the 30, or you take it out 20 more years. Imagine only what that rate might be. And it just doesn't gain you anything. It sounds good, looks good on paper, but it's not going to work.
And what Dwight's talking about too is the treasury curve, where we have short-term treasuries, we'll call 0 to 2 year at what is 3.5%. The 10-year sitting at 4.15, 4.17. 20 and 30-year paper is up in the 470 to 480 level, which implies the market is saying rates aren't going to stay down here forever. And it's also pricing in our $40 trillion of debt, right? And to your point, who wants to have 50-year exposure, right? Because if rates move by 1%, you're instead of getting 4.5% for 50 years, you could have gotten 5.5%. Well, the price would drop on your bond that you own by about 50%, because that's 1% a year for 50 years, right? So is that an investment that anyone wants to make, especially in this sort of mark-to-market world? I would say no.
Well, and remember, part of the Dodd-Frank was they developed that qualified mortgage rule. You'd have to blow apart that whole qualified mortgage rule to allow something longer than 30-year term. It could only be a maximum length 30 years. So they'd have to blow that whole thing up. It's a big mess. It's not worth it.
A lot of yarn to unwind.
Yeah. Not ready to go through that again.
So I'd say any notable concerns, like kind of as we round out, that you guys are thinking about in your space, or are you more cautiously optimistic? Again, just as I sit here, given the thought that rates are coming lower, Dwight, sounds like you probably are in your space.
Yeah, I think it'll be. I think you'll see volume over 25, which is over 24. I think you'll see, 2.3 trillion, somewhere in that range, which would be a nice, healthy market.
And Corey,
I agree.
You think so too, just rates wise?
I think whether it's the right thing to do or not, they're going to force these rates down, which should be beneficial to the buyers. It'll probably, unless you get a ton of people selling their house because they can finally get out of the one they've been stuck in for 10 years, if they kind of hold tight, then you should be able to keep your pricing and make it more affordable for the new buyer. That John and Dwight and I have talked about it, I'm curious on your thing, I mean, we don't have enough time, is to us, we were talking about last week, it feels like with what they're going to do with the Fed and make these changes and force these rates down, you're going to run this economy super hot, including houses, for a couple years, and then it's anybody's guess what happens after that.
I completely agree. I think it's going to be very hot. I think you're going to see the inflation angst price in, and that's the one we got to keep a close eye on. Rates will inevitably tell you where inflation is going to go. Right now, seems pretty calm, but if we get some of this stuff through, you could see rates pick up.
That was Corey's retirement cue.
Appreciate it. Thanks again, everybody. Talk to you tomorrow.
Dwight Millard, NMLS ID number 241259, a licensed mortgage loan officer with Highlands Residential Mortgage Limited and Equal Housing Lender. NMLS ID number 134871. The information shared on this live broadcast is for general information purposes only and does not constitute financial or mortgage advice. Listeners should consult directly with a licensed mortgage professional for guidance tailored to their specific situation. All loans are subject to credit approval and program guidelines. Not all applicants will qualify. Loan terms and availability may vary by state and are subject to change without notice. Highlands Residential Mortgage Limited is licensed in multiple states. For a full list of state licenses and disclosures, please visit https://www.highlandsmortgage.com/licenses/. The views expressed during this program are their own and do not necessarily reflect those of Highlands Residential Mortgage Limited.